Walgreens Boots Alliance stock, ticker symbol WBA. This stock is down 30% year to date, which is quite a lot. The overall market is down only 21% year to date. On the 13th of October, Walgreens presented quarterly results where they beat on EPS normalized, but missed on EPS GAAP. Walgreens also beat on revenue. The stock went up roughly 50% after earnings and the following days. The reason why people love Walgreens is because of the dividends, of course. 5% dividend yield and a payout ratio of only 38% and 29 years of dividend growth. But does this also mean that Walgreens stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Walgreens does. The most recent earnings, the historical returns, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Walgreens do? Walgreens Boots Alliance is a leading retail pharmacy chain with about 13,000 stores in the US and internationally. Walgreens' core strategy involves brick-and-mortar retail pharmacy locations in high-traffic areas, with nearly 80% of the US population living within 5 miles of a store. If we dive in the quarterly report, we'll see some interesting things happening. First of all, sales is down year over year, which is something that I don't like, of course, especially since cost of sales decreased only a tiny bit. Gross profit is down from 7.5 to 6.4, which is a big decrease. Operating income is also down big time, which is something that worries me a bit. Bottom line, Walgreens has a basic net loss earnings per common share of 48 cents, down from 41 cents positive, so that's a thing to keep your eye on. The two biggest segments, US Retail and Walgreens Boots Alliance, are both down in sales and gross profit, which results in a lower gross profit margin, of course. Bigger competition could be a big influence here. Full year 2022 looks a bit better. Sales is up only 0.1%, which isn't a lot, and up 1.2% in constant currencies. Operating income gap is down 40%, but adjusted is up 0.3%. Net earnings gap is up 117%, and adjusted is up 2.5%. EPS is the same story. The good part is that operating cash flow is up again versus last year, so this is something that I like. Walgreens expect a 0 to 3% increase year over year in sales in full year 2023. Adjusted operating income to decrease -7% to -4% year over year. And EPS is pretty much the same story. So Walgreens expects margins to decrease, which is something to keep in mind. But what's very interesting is the US healthcare segment. It's scaling to 5 billion sales with 45 to 55% pro forma growth. Sales is expected to increase 175 to 195% full year 2023 versus 2022. Adjusted operating income is expected to grow 5 to 11%. And adjusted EBITDA and EBITDA margin are also expected to grow in high numbers here. So this looks really good to me. They still have a long way to go with the earnings and some operating income here, but these numbers looks very good. And that's also reflected in this graph, where they increased the outlook to 11 to 12 billion, up from 9 to 10 billion, a 50% 3-year compound annual growth rate. In 2024 they expect to generate some profit with this segment, so as I just said, it's a long way to go, but this could be huge. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. WBA is a 32 billion market cap company with a PE ratio of 7.46, which is of course very low. The 5-year PE ratio is at only 9.9, which could indicate that they are undervalued. On the other hand, there's not much growth in this company, as we saw earlier in the quarterly results and the outlook. So you want to pay a lower multiple for this company. Later in this video I will show you my 3 price targets for Walgreens, so make sure to watch until the end. Revenue is at 132 billion, and in this graph we see that revenue went up and down quite a lot, so it's not really nice and steady, which I prefer of course. Net income is at 4.34 billion, which gives us a profit margin of 3.3%. But keep in mind that they expect margins to decrease in 2023. The good part for now is that the current profit margin is higher than the 5-year average. And with the growth of US healthcare segment and also turning profitable in 2024, I'm not worried about the future profit margin of this company. EPS is going up and down as well. And in the past couple of quarters it's decreasing, which is something that I don't like of course. Price to sales ratio is at only 0.25, which is pretty low. It decreased a lot over a longer period of time, but it's also very typical for these kind of companies to have a lower price to sales ratio. Price to book ratio is at 1.13 and looks pretty good to me, nothing special to mention here. Price to free cash flow is also looking pretty good to me. Usually you want this number below 20, but with these type of companies I prefer 15 or lower, since it's a slow growing company. Analysts are expecting 2023 to be a tough year in EPS and revenue growth. From 2024 things seem to look better, which is of course influenced by the US healthcare segment. EPS is expected to grow mid to high single digits and revenue growth is expected to grow at low to high single digits, which comforts me a lot to be honest. Return on assets is sitting at 4.6%, which is a bit on the low side. But it's also very common for these type of companies. Return on equity is at 16.6%, which looks pretty good to me. Return on invested capital, the most important number here, is at only 3.3%, which is too low in my opinion, since it's below my 10% minimum. On top of that, it's significantly lower than the 5-year average of 6.5%, so definitely keep an eye on this number. Current ratio is at 0.75, which looks good to me, especially since it's decreasing over a longer period of time. I prefer companies with a current ratio of 1.5 or lower. A thing that I don't like is the debt to cash ratio. Right now, total cash is sitting at 2.5 billion, while debt sits at 36 billion. I prefer companies who can pay down at least 33% of their total debt, so this doesn't look really good to be honest. Especially since free cash flow is going up and down quite a lot. I prefer a steady and consistent pattern here, since free cash flow is used to pay down debt of course, but also to buy back shares, pay dividends and all other things which are very important to Walgreens, so definitely keep an eye on this number. But a thing that I do like are the shares outstanding. Over a longer period of time it's decreasing. I prefer a bit more steadier and consistent pattern here, but okay, it's going down, which is a good thing. To me this is very important since this increases your ownership in the company, but also increases the EPS, lowers the PE ratio and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyway, Walgreens is loved among the investors because of the dividends. Dividend yield is at 5% and Walgreens has an annual payout of $1.92 a share. Payout ratio sits at only 38%, which is something that I really like. They have 62% left in cash to pay down debt, buy back shares and all other things, so this looks really good to me. The 5-year growth rate is at 4.63%, which is a bit low. But to me it's more than enough since dividend yield is already at 5%. Walgreens did increase the dividends for 29 years in a row, which is really impressive. Overall a great looking dividend scorecard. But how about the historical returns versus the S&P 500 and some competitors? I decided to include the S&P 500 as a benchmark since this is one of the easiest ways to invest. Just buy an S&P 500 ETF and wait. I also included Rite Aid, ticker symbol RAD, and CVS Health. On the 5-year chart we see a minus 33% return with Walgreens, including dividends, so this doesn't look very good to be honest. The S&P 500 had a 61% return, so you were better off owning the S&P 500. ARD returned minus 81% and CVS returned almost 70% and also beaten the S&P 500 by a small margin. On the 1-year chart we still see a minus 20% return for Walgreens versus minus 17% return for the S&P 500. RAD performed very badly and CVS is again the winner here. On the 6-month chart it's pretty much the same story. All stocks are down except for CVS. But on the 1 month chart, Walgreens returned 25% versus the S&P 500 only returning 5%. RAD and CVS returned also a pretty decent amount. So overall, WBA stock didn't perform very well and was beaten by the S&P 500 in most cases. But most recently the stock did pretty good and had some interesting results for the long term. So does this mean that WBA stock is a buy? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. As we all saw, it's expected that revenue isn't growing in high amounts with this company. But according to the analysis, from 2024 they will grow in mid-single digits. To be honest, I'm a bit more conservative, so I'm filling in 0.5, 1.5 and 2.5%. For the profit margin, we saw a decrease, and it's expected that profit margin is going to decrease in 2023 as well. From 2024, it's expected that margins will increase again, with the US healthcare segment becoming profitable. I'm filling in 1.5, 2 and 2.5%. Free cash flow margin, I'm filling in 1.5, 2.5 and 3.5%. For the PE ratio and price to free cash flow, I'm filling in 11, 12 and 13, since I don't want to overpay for a slow growing company where margins aren't that high. My desired annual return is 12.5%, since I can get an easy 10% average annual return with owning an ETF. Right now, Walgreens is at $37. I hit analyze and we see a few green numbers. We have a low price target of $21, which is a big drop from the current stock price. We have a mid price target of $31 to $39, and we have a high price target of $43 to $60. To me, the mid to high price target seems to be the most justified here. But I would say that $31 to $43 is the most realistic scenario. $60 seems a bit too high in my opinion. My final conclusion on this stock is that there are some interesting things happening. From a dividend perspective, this looks really good. Payout ratio is really low and dividend yield is at 5%. On top of that, they are growing the dividends pretty steady. But from a value point of investing, it's a bit more difficult. It's a slow growing company and the price target of $31 to $43 is the most justified in my opinion. Right now it's at 37, which is a bit at the high side. So I do think with the US healthcare segment that this company could grow in profit margin and also has some growth potential. But 37 seems to be a bit too high right now. I think I prefer a higher margin of safety, and with the current market conditions I wouldn't be surprised if the stocks fall down to again $30. So for now I'm waiting for a drop, and from there I'm going to analyze this company again. Dividends are great, but I want a higher margin of safety. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.